Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, July 28th, 2023. Anyone surprised by the FOMC's decision to raise interest rates by another quarter point a few days ago hasn't been paying attention to what Fed Chair Jerome Powell has been saying for the past month, or is in denial about his determination to bring inflation back below 2%. After this week's rate hike, the Fed's policy rate, also referred to as the Fed funds rate, is now in a range of 5.25% to 5.5%. And here's the Fed statement from a few days ago. And right there, you can see it, 5.25% to 5.5%. That is the highest it has been since March of 2001. And I'm showing you a chart now. And by the way, this chart only goes through June. The St. Louis Fed has not updated it yet for this week's decision. But if they did, it would be a little higher than the 5.26 you see from about 15 years ago. And it would have to go all the way back to 2000, 2001. However, there's a big difference between now and 2001, 2002. And that is, at that time, the FOMC was cutting rates to spur economic growth. Now it's raising rates to discourage consumer spending and thereby drive down inflation. Thus far, that strategy has produced mixed results. Although the inflation growth rate, as measured by the Consumer Price Index, has slowed down, it is still higher than the Fed would like. At the same time, the Consumer Confidence Index hit its highest level in July in 2 years. Now, here's a chart going back also to 2007. And again, this hasn't quite been completely updated, but you can see back here actually it was July of 2021, higher than it is now, but this is as high as it's been since then. And that was before, by the way, 2 years ago, before the FOMC began raising interest rates. So why are consumers feeling more confident now than they were then? One reason is the waning threat of COVID-19. Over the past 2 years, vaccines for the virus have greatly diminished its impact on the global economy. Although that may explain why people are feeling less pessimistic about the economy, it does not necessarily explain why they're feeling better about it. Perhaps it's the belief that the Fed is nearly done raising interest rates, regardless of what the incoming economic data looks like later this year. However, Jerome Powell has made clear in his comments this week that he will be looking at the data closely to determine future Fed monetary policy decisions in the months to come. Yesterday's advanced estimate of second quarter gross domestic product in the United States may give Powell the cover he needs to raise rates again. The economy grew at an annualized rate of 2.4% during the quarter, better than the 1.8% figure widely anticipated. It looks like all those confident consumers are keeping the economy going. And here's a chart of quarterly GDP, and you can see it was slightly negative in the second quarter of 2022 when the Fed started raising rates. Since then, it's been slightly positive, and you can see the second quarter was slightly higher than the first quarter. That's why this morning's personal consumption expenditure index numbers for June caught Wall Street by surprise. After yesterday's strong GDP report, the fear was that today's PCE report would reflect higher inflation than the Fed would like. Instead, PCE grew at a 3% pace over the past 12 months, considerably less than the 3.8% rate reported for May, and you can see 4.3 in April, 4.2 in March. So, and this is, by the way, PCE is the index that Jerome Powell feels is the more accurate gauge of the trends in inflation than as CPI. In short, there seems to be a disconnect between how consumers are feeling and what some of the data is indicating. The organization that publishes the Consumer Confidence Index, the Conference Board, acknowledged, although consumers are less convinced of a recession ahead, we still anticipate one likely before year end. The only data point that objectively supports higher consumer confidence right now is the tight job market. As long as unemployment remains low and wages keep rising, consumers should have income to continue spending as they have in the past. But if unemployment starts to rise and wage growth slows down, consumer confidence could quickly reverse direction. That's this week's PF Video Update, and I look forward to talking to you next week. Thank you.